Hello everyone. In this part we're going to be covering the factory overhead variances. So factory overhead variances is the last type of variance that we need to care about when we're talking about evaluating performance. So factory overhead costs are analyzed differently than direct labor and direct material costs. Why is that? Because factory overhead costs have fixed and variable cost elements or components. So, for example, indirect material and factory supplies normally behave as a variable cost as units produced change. But on the other side, straight line plant depreciation on factory machinery is a fixed cost. It would never vary from one period to another. It's a fixed amount. So both of these are overhead cost, but as you can see, one is considered to be like a variable cost while the other is a fixed cost. So factory overhead costs are budgeted and controlled by separating factory overhead into fixed and variable components. So if we start with the factory overhead flexible budget, so to calculate the factory overhead rate, we have to get the budgeted factory overhead at normal capacity, and we divide that by the normal productive capacity or normal production capacity. So the factory overhead rate here, we start by the budgeted factory overhead at normal capacity, would be $30,000. The number or the normal productive capacity is 5,000 direct labor hours. So dividing 30,000 by 5,000 hours, that's $6 per direct labor hour. So for Western Rider, 100% of normal capacity is 5,000 direct labor hours. If it's more than 100%, we can see that it's going to be more than the 5,000. If it's less than 100%, then it's going to be less than the 5,000. So the budgeted factory overhead cost at 100% of normal capacity is 30,000, consisting of variable overhead of 18,000 and fixed overhead of 12,000. Again, everything now is just given to us. So for analysis purposes, the budgeted factory overhead rate is subdivided into variable factory overhead rate and a fixed factory overhead rate, as in the next slide. So in this slide here, we can see that we have the variable factory overhead rate and we have the fixed factory overhead rate. How we calculate the variable factory overhead rate? We get the budgeted variable overhead at normal capacity, which was given to us as 18,000. And we divide it by the 5,000 direct labor hours, and that turns out to be $3.60 per direct labor hour. For the fixed factory overhead rate, we get the budgeted fixed overhead at normal capacity divided by the normal productive capacity. Keep in mind, this 12,000 is fixed, but the fixed factory overhead rate would keep changing based on the direct labor hours. So we take the 12,000 divided by 5,000, and that would be $2.40 per direct labor hour. So in summary, the budgeted factory overhead rate for Western Rider Incorporated would be as follows. We have the factory variable or the variable factory overhead rate to be $3.60. The fixed factory overhead rate is $2.40. So the total factory overhead rate is $6. And that's the $6 that we had in the previous slide here. So if we create an Excel sheet where we have the factory overhead cost budget for the month ending June 30th. And on the third column here you have the 100% capacity. So if 100% capacity, the direct labor hours would be 5,000 hours, the units produced would be 6,250, and we have here a group of variable cost and a group of fixed cost. In the variable cost we have the indirect factory wages, the power and light, we have the indirect material. But for the fixed costs, we have things that would not change. You see here supervisory salaries, depreciation, and insurance and property taxes. You can see across different percentage of capacities, these values are always the same. In the fourth column, we actually increase that to 110. And in the variable cost section, you see that the factory wages, the power and light, and the direct material would keep changing based on the percentage. So we add the variable cost and the fixed cost, and we get the total factory overhead cost based on different scenarios of capacities. from 80%, 90%, 100%, and 110. So remember, the factory overhead rate per direct labor hour was the 30,000 based on 100%. This 30,000 divided by 5,000 hours, and that was the $6. So let's speak about the variable factory overhead controllable variance. The variable factory overhead controllable variance is the difference between the actual variable overhead cost and the budgeted variable overhead for actual production. So in simple words, the variable factory overhead controllable variance would be actual variable factory overhead minus budgeted variable factory overhead. If the actual variable overhead is less than the budgeted variable overhead, the variance is favorable. So in other words, if we end up having a negative variance, that's considered to be favorable. But on the other side, if the actual variable overhead exceeds the budgeted variable overhead, then we have an unfavorable variance. So the budgeted variable factory overhead is the standard variable overhead for the actual unit produced. So we see here the standard hours for actual units produced multiplied by the variable factory overhead rate, and that will give us the budgeted variable factory overhead. So let's try to apply that to our example. So the budgeted variable overhead for Western Writer Incorporated would be calculated as follows. We have the standard hours for actual units produced to be 4,000 direct labor hours multiplied by the variable factory overhead rate. Remember, we turn out to be $3.60 and the fixed factory overhead rate is $2.40. So now we're focusing on the variable is $3.60. So the budgeted variable factory overhead would be $14,400. So if we assume that Western Writer incurred the following actual factory overhead, the actual was $10,400 and the fixed factory overhead was $12,000 for a total of $22,400, we're going to focus now on the $10,400 and compare it to the $14,400, which is the budgeted amount. Actually, we turned out to have a $4,000 negative, which is a favorable variance. So minus 4,000, that's a favorable variance, but that's focusing on the variable factory overhead. So let's see the fixed factory overhead volume variance. The fixed factory overhead volume variance is the difference between the budgeted fixed overhead at the 100% of normal capacity and the standard fixed overhead for the actual units produced. So how we calculate the factory overhead volume variance again? It's the standard hours for 100% of normal capacity minus the standard hours for actual units produced multiplied by the fixed factory overhead rate. Remember, this fixed factory overhead rate for our example was $2.40. So an interpretation of unfavorable and a favorable factory overhead volume would be as follows. An unfavorable fixed factory overhead volume variance means actual units produced is less than 100% of normal capacity. Therefore, the company used its fixed overhead resources less than would be expected. In a favorable fixed factory overhead volume variance means actual units produced is more than 100% of normal capacity. Therefore, the company used its fixed overhead resources more than would be expected. So if I go back to this table here, at 110%, the fixed cost overhead, the total fixed here, is divided by larger number of units produced. But if it's less than 100%, like the 90% and 80% cases, the same fixed overhead is divided by a smaller value of units produced, and that would lead to a higher fixed cost rate. So let's apply that to our example. Remember, the fixed factory overhead volume variance for Western Writer is calculated as follows. We have the standard hours for 100% of normal capacity, which is 500 direct labor hours, minus the standard hours for actual units produced, which is 4,000 direct labor hours. That's a 1,000 labor hours difference, multiplied by the fixed factory overhead rate, which is $2.40, that's 2,400 unfavorable variance. So remember, the variable factory overhead volume variance turned out to be 4,000 favorable because it was a minus, but the fixed factory overhead volume variance turned out to be positive, which is an unfavorable variance. So the total factory overhead would be still favorable, but it's going to be only the difference, which is about $1,600. So Western Writer's fixed factory overhead volume variance is unfavorable in June because the actual production is 4,000 direct labor hours, or 80% of normal volume. So again, let me go back to this 80% here. You see here the direct labor hours were 4,000 because that was the units produced, which was below the 100% capacity. So the unfavorable volume variance of 2,400 can be viewed as the cost of unused capacity, or in other words, the 1,000 direct labor hours. So let's try to visualize that. So see here we have this graph where we have the direct labor hours starting from 500 all the way to 6,000 and the dollar values, and here starting from 2,000 all the way to 16. You see here that the standard fixed hour overhead, which is $2.40 per hour, that would keep increasing as the direct labor hours increase. So that would increase the dollar values. So the budgeted fixed cost here, that's the $12,000, that's the fixed amount here. So since we only produced 4,000 or used 4,000 direct labor hours, so that's our standard fixed overhead at actual production. You see here it's below our budgeted fixed cost. So this is the area that's considered to be the unfavorable volume. So up to 5,000, everything would be unfavorable volume variance. And in our case here, the difference between the 12,000 and this value here would be the unfavorable variance, or the unfavorable volume variance. Any point that exceeds 5,000 direct labor hours on the right hand side here, that would be favorable volume variance. Remember, the 5,000 was the 100% of normal capacity. So anything above the 100% would turn out to be a favorable volume variance. Now let's talk about reporting factory overhead variances. An unfavorable volume variance may be due to factors such as failure to maintain an even flow of work. So the flow of work is fluctuating, or there are breakdowns in the machinery, or it could be work stoppages caused by lack of material or skilled labor. So we ran out of material, or maybe the skilled labor are not available. Or it could be lack of enough sales orders to keep the factory operating at normal capacity. So all of these are reasons that can be leading to unfavorable volume variances. So total factory overhead cost variance can also be determined as the sum of the variable factory overhead, controllable and fixed factory overhead volume variances. So remember, our variable factory overhead controllable variance was a minus 4,000, which is favorable variance, but our fixed factory overhead volume variance turned out to be a positive 2,400, which is an unfavorable variance. Yet the total factory overhead cost variance was favorable because the amount of the variable factory overhead controllable variance was much larger than the fixed factory overhead volume variance, which is unfavorable here. So the bottom line here is $1,600 favorable variance. So a factory overhead cost variance report is useful to management in controlling factory overhead costs, and we have an example here that can give us more information about that. So here we have the production capacity for the month, 100% of normal, that's 5,000 hours, but our actual production for the month turned out to be only 400 labor hours. So in this second column we have the budget at actual production, and on the first column we have the actual cost, and then on the right two columns here we have the variances, and we're going to differentiate between the unfavorable and the favorable variances in two different columns. So you see here the variable factory overhead cost. We have the indirect factory wages, the power and light, the indirect material. All of these are the actual costs, and these are the budget at actual production. And you can see that for the factory wages, it turned out to be favorable. For the power and light, it's unfavorable. For indirect material, it's favorable. And then for the fixed factory overhead, they're exactly the same as budgeted. So the total factory overhead cost here is $22,400 for the actual cost, but for the budget it's $26,400. So the total controllable variances, here we have 200 for the unfavorable and the 4,200 which is the favorable. So the net controllable variance turned out to be favorable at $4,000, which is the net of these two values. So that explains the variance, the 4,000 net controllable variance. If you want to talk about the volume variance, and in this case it turned out to be unfavorable, we have the capacity not used at the standard rate for fixed, which is 1,000. Remember the difference between the 5,000 and the 4,000, that's 1,000, multiplied by the fixed factory overhead rate, which is $2.40, and that turned out to be a positive 2,400. If we combine the net controllable variance to the volume variance, which is a minus 4,000 plus a positive 2,400, that will give us a minus 1,600, which is a favorable total factory overhead cost variance. You can see that this report here provides more details. You see exactly where the areas that are considered to be favorable compared to other areas that are unfavorable, and you can also know how much is the volume variance based on the capacity that haven't been used at the standard rate. So now let's talk about the factory overhead account. Usually accountants would create a T accounts for the factory overhead, and this is where we apply the factory overhead, and we'll see that we're using the applied factory overhead and how it's presented on the T account. So the applied factory overhead for Western Writer Incorporated will be calculated as follows. Remember, we have 5,000 jeans, so multiplied by 0.80 direct labor hours per pair of jeans, multiplied by $6, which is the total factory overhead rate. So that's 4,000 direct labor hours multiplied by the rate of $6, that's 24,000. So the total factory overhead cost variance for Western Writer would be calculated as follows. We have the actual factory overhead minus the applied factory overhead. So the actual turned out to be 22,400, but the applied is 24,000. So that led to the 1,600 favorable variance. Of course, this does not explain the details like the previous table, but again, here we're talking about the T accounts and how it's presented. So I just want to show you here on the factory overhead T account. Applied factory overhead is always recorded on the credit side, so we have the 24,000. That's 4,000 hours, which are the actual hours multiplied by the $6 per hour, and that turned out to be 24,000. But the actual factory overhead turned out to be 22,400, which is 10,400 plus the 12,000 variable and fixed, so that was 22,400. You can see here that our factory overhead was over applied. We applied more than we actually had in overhead. So when we have an over applying, that's a favorable situation where we end up having a credit balance. That's an over applied factory overhead. So let me explain here based on what we have in the slide. So it says at the end of the period, the factory overhead account normally has a balance. A debit balance is not good, represents an under applied overhead, and a credit balance represents an over applied overhead. Under applied and over applied factory overhead account balances represent the following total factory overhead cost variances. Remember, under applied factory overhead is unfavorable total factory overhead cost variance. But when we have an over applied factory overhead like this scenario here, then that's a favorable total factory overhead cost variance. So let's try to analyze the reasons between the actual factory overhead versus the applied factory overhead. Remember, the factory overhead, the applied factory overhead is 24,000, and that's always recorded on the credit side. The actual factory overhead would be recorded on the debit side, and that's 22,400, which is less than what we have applied. In the middle here, we can calculate the budgeted factory overhead for amounts produced, which is the 4,000. Okay, so 4,000 multiplied by $3.60, that's 14,400, and we have the fixed factory overhead. That's a fixed amount, it's not going to change. That's 12,000, and for the total of 26,400. So the difference between the actual factory overhead and the budget factory overhead for amount produced is about $4,000, and that's a favorable, and that's what we call the controllable variance. And actually, this is what saved the factory overhead, because on the other end, if you compare the applied factory overhead to the budgeted factory overhead for amount produced, it's actually unfavorable. So that's what we call it the volume variance, and it's 2,400. The combined total factory overhead cost variance is $1,600, which is the total of these two values, and it's actually negative, which is a favorable situation. Now let's do a quick knowledge check. So GB Industries Incorporated produces a line of luxury home furnishing. During the most recent period, its actual factory overhead was 28,500, and its applied factory overhead was 22,700. What is the balance of the factory overhead account at the end of the period? So the actual is 28, the applied is 22. Do you think we over-applied or we under-applied? I think in this case, it's very obvious that we under-applied, since the applied is less than the actual. So we have an under-applied by the difference, which is 5,800. So the right answer is A. So in the factory overhead account, actual factory overhead is debited. Remember, actual is always on the debit side. That's the left side of the T account. And applied factory overhead is always on the credit side, which is the right side of the T account. Since the actual factory overhead is 28,500 and the applied factory overhead is 22,700, they are under-applied by 5,800 or 5,800. This would result in a debit balance in the account of 5,800. Now let's see the recording and reporting variances from standards. So many companies include standard cost in their accounts, and one method for doing so record standard cost and variances at the same time the actual product costs are recorded. So if we go back to our example, Western Writer Incorporated purchased on account 7,300 square yards of denim at $5.50 per square yard, which has a standard price of $5 per square yard. So see here that we actually have an unfavorable situation because we bought the yards at a price higher than the standard price. So to record the purchase and the unfavorable direct material price variance would be as follows. So we credit, I'll start here with a credit. So we leave some room for the debits, but I want to show that the accounts payable would be based on the actual yards purchased and the actual price of the yard. So 7,300 multiplied by 5.5, and that's 40,150. We're going to debit material based on the standard price. Okay, so material is debited for 7,300. That's the actual yards purchased at the standard price, and that's turned out to be 36,500. The difference is the direct material price variance. And again, you see here, this is on the debit side, and it's a situation where it's considered to be unfavorable because we paid higher. So debit balance in the direct material price variance account represents an unfavorable variance, which is what we have here, and a credit balance represents a favorable variance. Now let's see the quantity variance. So the direct materials quantity variance would be recorded in a very similar manner. So we start with the actual work in process, which is the actual yards used, 7,500. So we debit the work in process, 7,500, based on the actual price, or actually the standard price, which is $5, so that's 37,500. And then we credit material based on what we purchased, 7,300 square yards. That's at $5, which is the standard price, and that's 36,500. The difference between these is 1,000. It's actually on the credit side, and we record that as direct material quantity variance. And since it's on the credit side, I think this is a favorable situation. So a debit balance in the direct material quantity variance account represents an unfavorable variance, and a credit balance represents a favorable balance or a favorable variance, which is what we have in this situation. So recording and reporting variance from standards, that's the last thing that we need to understand and focus on. I know it's not as critical as everything that we've discussed, but it might be a little bit intense. I just want you to try to understand it with some kind of, or as they call it, with a grain of salt. So the journal entries to record the standard costs and variances for direct labors are similar to those for direct material, and they are summarized as follows. Work in process is debited for the standard cost of direct labor. Wages payable is credited for the actual direct labor cost incurred. The direct labor rate variance is debited for an unfavorable variance and credited for a favorable variance. Similarly, direct labor time variance is debited for an unfavorable variance and credited for a favorable variance. So the actual factory overhead is compared with the budgeted factory overhead to determine the controllable variance, and the budgeted factory overhead is compared with the applied factory overhead to determine the volume variance. So we have controllable variance and we have the volume variance. At the end of the period, the balances of each of the variances or the variance accounts indicate the net favorable or unfavorable variance for the period and are reported in an income statement prepared for management's use. So that's not for external use, it's only for management use. And we'll see an example here. And again, here we have the sales, 140,000, and we have 5,000 units sold at $28. We have the cost of goods sold at standard, okay, and that's 97,500. So we get the material, the labor, and the overhead. That's from Exhibit 3. Or maybe we can use 5,000 units sold at $19.50, and that's going to be 97,500. And that's the cost of goods sold at the standard. So the gross profit at standard would be the difference between the sales and the cost of goods sold, which is 42,500. Then we go over the variances from standard cost, and we split it into two columns, unfavorable and favorable. Yet these are, we can consider them as one column where the minuses are considered to be favorable and the pluses are considered to be unfavorable. But just to make it more easy to see, we split these two. We split them into two columns. One column is unfavorable and the other is favorable. And here we have the direct material price, the quantity, and then we have the direct labor rate and direct time, and then factory overhead, controllable variable, and factory overhead volume. So that combines everything that we had in the previous slides. So we have the material price, the material quantity, the labor rate, the labor time, the overhead controllable, factory overhead controllable, and the overhead volume. And then we combine these together in net variance from standard cost. And in this case, since it's a negative value, it's actually a positive value because the unfavorable here turn out to be higher than the favorable. It turned out to be a positive value, so that's considered to be unfavorable. The reason we put it between parentheses here is because we want to subtract it from the 42,500, and that will give us the gross profit. So operating expenses, we have selling expenses, we have the administrative expenses, we subtract the total here from the gross profit to get the operating income. Again, remember, this income statement is just used for managerial purposes or for management purposes. All right, the last part of this chapter is some analysis for decision making. And here we have an example for service staffing variances. So standards can be used in non-manufacturing settings where the tasks are repetitive in nature. Remember, that's what we discussed earlier. So to illustrate, we have here Marriott Hotel uses labor standards to control the cost of the housekeeping staff, where a housekeeping employee is expected to clean a room in 42 minutes and is paid $13 per hour. Some information for a recent week are as follows. We have the number of guest rooms nights are 1,050. We have the number of housekeeping staff hours to be 840. So this is information that was provided for us. The guest room nights can be translated into standard staff hours as follows. So the number of guest rooms we have was given to us as 1,050 multiplied by the standard hours per room. Remember, 42 minutes. If we multiply that by 60, that will give us about 70% of an hour. Okay, so 70% of an hour multiplied by number of guest rooms. The standard housekeeping staff hours should be 735 hours. Yet the actual numbers are 840. Do you think this is favorable or unfavorable? It's obvious that this is unfavorable because the standard housekeeping hours were expected to be 735, but the actual one turned out to be 840. So a direct labor time variance can be computed as follows. Actual staff hours minus the standard staff hours multiplied by standard rate per hour. So we get 840 minus 735, and that should be about 105 multiplied by $13 per hour, and that would be $13.65. And again, see, it's a positive value, it's unfavorable. So the actual staff hours were greater than the standard hours, causing an unfavorable staff time variance. We need to know the reason. So management can investigate the causes of the variance, which may include things like overscheduling staff or insufficient staff training, or maybe difficult room cleaning situations and staff inefficiencies. So all of these could be the reasons. But again, the idea of doing these kind of analysis is to try to know or be aware of the problem, and then we try to analyze the problem, if there's a problem. So by that, I conclude chapter 23. I wish you all the best, and please keep studying hard, and I wish you all the best.